Good evening, sir. My host, good evening.
Good evening, sir. Go ahead.
All right, thank you, sir. Good evening, everyone. Welcome once again to our usual class here on this platform. We are still on session 3 of our material, which is on business valuation. And of course, I think we're in the third question, right? If I'm not mistaken. Yes, we started solving this question. And of course, we've solved the first part of the requirement, which is a requirement A. And I want to believe that we have gone through the solution once more, and we are able to understood how we uh, arrive at figures for the computation of the free cash flow. So before I progress to the next requirement, let me see whether you have any question regarding the solution here, regarding what we did yesterday. If you have question in the next 1 minute, let me see before we progress. Okay, there is no question. Let us continue. So let us look at requirement B. What is requirement B requesting that we do here? Having computed the free cash flow in requirement A, requirement B is now saying that we should what? Estimate the value of the business based upon the expected free cash flow to equity and a terminal value based upon a sustainable growth rate of 3% per annum thereafter. So if you look at A, we have computed those free cash flow already. And the question let us know, if you look at the question, we're told that the free cash flow is expected to grow by what rate? Let me see. Let me see that rate given to us here. Okay, I think it's the requirement. Okay, let me check the requirement. The requirement. Okay. Sorry, excuse me. Okay, so it's in the requirement. See, look at the requirement here. We're told that after the third year, the free cash flow is expected to go at what? 3% every year into perpetuity. So, the question also gives us our cost of equity, the one I explained yesterday. I dwelled more on this yesterday, differentiating between return on equity and cost of equity, right? So our cost of equity here is 10%, and our growth rate after year 3 is 3%. So what will I do? I will discount these free cash flows here. The free cash flows I have here, I will discount them using the cost of equity of 10% from year 1 to 3. And after year 3, I will grow it to year 4, and I discount to perpetuity. Okay? So let us continue. Requirement B. So look at it. These are the free cash flow we computed up there. And our discount factor is at 10%, which is cost of equity. So 10% discount factor year 1 is 0.909, year 2, and we have it for year 3 as well. So when you multiply this, you get your present value of year 1 to 3. That is very straightforward, right? That is very straightforward. Present value year 1 to 3 is what we have here. And then we now come to what? Present value after year 3 to infinity. So after year 3 is year 4. So from year 4 to infinity, what should be our present value of the expected free cash flow? So what will I do? I will pick year 3 figure. Look at year 3 figure here. Year 3 figure is 173. Now I pick that 173. I will grow it by what? By 3%. Because the question has let me know that after year 3, free cash flow will now grow at what? At 3%. So grow your 173 by 3% and discount it using the cost of equity minus the growth rate. That's what we have right there. Look at it. 173 into bracket 1 plus 0.03 all over cost of equity is 0.1 minus the growth rate of what is 0.03. And I told you, when you are dealing with perpetuity with growth, you have to look at your base year, right? What's my base year here? My base year is the year from where I'm bringing this 173. Look at 173 in my solution. From which year is that 173 coming from? It is coming from year 3. Can you see that? It is coming from year 3. So year 3 is my base year. Okay, year 3 becomes my base year. So I have to multiply whatever result I get from here. I have to multiply by the discount factor of the base year. Discount factor of base year is 0.751. So when you evaluate that, we have 1,912. That is present value year 4 to infinity. So the total value of the firm now will now be 353, which is A, addition of all what you have here, addition of all what you have here, plus 1912. So the total market value of the company's equity is $2,265 million. $2,265 million. So that is how to compute your market value using free cash flow to equity. My host, please can you confirm that you can hear me clearly?
The network is fine, go ahead.
So, Ahmed Munir, you may have to restart your system. Thank you. So let us continue. So that's how to value your equity using free cash flow to equity. Okay, you can see that what we simply did here is that we discounted the what? The expected free cash flow that we are hoping that we get, that this equity will give to us. We discount it using the cost of equity. Like I said to you at the beginning of the class, that when you discount the benefit associated with a particular item, by the cost of that particular item, you get the market value of the item you are trying to what? To value. So the same thing we have done here, we just look at the associated, the expected, the free cash flow to our equity, then we discount it using the cost of equity. Okay? So let's, any question on B before we go to C? Any question on B before we go to C? Do you have question there? Now, question C is bonus, is bonus. Question C is bonus, okay? Now, question C just is about what? Limitations. It's about limitations. We did not calculate value of firm. Look at what the question asks you to calculate. Evaluate the what? Evaluate the value of the business based upon the expected free cash flow to what? Expected free cash flow to equity. So when you discount free cash flow to equity, you get cost of market value of equity. So you are not adding debt, because the question has told you that the basis should be what? Free cash flow to equity. And we all know that when we discount our free cash flow to equity, the market value that comes out is what? Is market value of equity. So you don't go and add debt to it. You understand? That's the reason why we did not add the debt to it. So state the limitations of your computations above. State the limitations of your computations above. Now, what limitations can I pick from here? Number one is that I will come to my target rate of return on equity, 10%, right? Now, this rate will have been computed using capital asset pricing model, because I don't even know the basis of computation, Abi. I'm assuming that it was computed using CAPM. So if it is CAPM that was used to compute this uh, rate of return, then it means the rate of return will be limited or will be affected by the assumption of the CAPM. What is the assumption of the CAPM? The CAPM assumes that investors will have diversified away all unsystematic risk, right? All unsystematic risk are diversifiable. So the assumption of the CAPM is that unsystematic risk will have been diversified away. Okay, so the cost of equity here will only reflect systematic business risk. Whereas in actual sense, investors' return is supposed to recognize both the systematic and unsystematic, the one we call total risk. Okay, so we need total risk as against what? Systematic risk. But the CAPM only take cognizance of what? Systematic risk. So that is the first limitation you can think of. Let's go again. Look at our uh, the assumption that okay, I think is the requirement. The assumption that our free cash flow will grow by 3% to perpetuity is not realistic. Okay, it's not realistic. We are saying that okay, after year 3, our cash flow will be growing every year into by 3% to perpetuity. It is an unrealistic assumption, and it's going to affect our what? Our computation. So that is another limitation you can think of. Another limitation you can think of is that our computation of the market value of Kodiak's equity has been based upon that Kodak will operate into perpetuity. Okay, that is, the company is not going to liquidate at any point in time. And once again, this is not realistic. Okay, it is not realistic. The market value we got there, that 2005 something there, is based on the fact that Kodiak will operate into perpetuity. And in actual sense, uh, it might not what? It might not be the case. That might not be the case. What other assumption can you think of here? We have also assumed that both revenue and growth and both revenue and the variable cost, which is our cost of sales, will grow by what? 9%. 9% for the next 3 years. So look at it. Revenue and variable costs are projected to grow at 9%. That again is not realistic. Revenue and cost might not grow at the same pace. You understand? So one may grow much more than the what? Than the other. Therefore, the assumption that the two of them will grow at the same rate is not realistic. These are some of the what? Some of the uh, assumptions that we have made that we pose a limitation to our computed market value of equity in this question. Okay, so there's that about solution to question 3. Solution to question 3. Now, let us quickly go to question 4. But before we go, let us now see if you have any question on this. And like I told you yesterday, that you need to take this question very seriously. Mrs. Charity, please, why didn't we add Ben? Okay, I've responded to that. I've responded to that. Okay. Please, variable costs and fixed costs of operating expense are not correct. They are not correct. How are they not correct? Okay, let's go there. Place variable cost and fixed cost of operating expenses are not correct. Okay, let's go there. Let's go and check. We're told that the variable cost is what? Variable cost is 15% of sales. Where do we have that? Variable cost is 15% of sales. So what is 15% of 5450? 0.15 times 5450. 81818. So how is it not correct? I don't understand. How is it not correct? So let us continue. There's nothing wrong with the figure there. What do you want to explain on the depreciation, please? What's there that is not clear on the depreciation so that we can iron it out? Obviously, I can't start the debate from the beginning. So just tell me where you don't understand so that. Okay. Okay, maybe it was not in class yesterday, right? Okay, I understand now. This is, I said it yesterday, I said this is supposed to be 50%. Like you have to do the question, that 9%. So this one here, this one is 15%. Maybe you did not attend the class yesterday. This one here is 50%, not 9%. Go and check the question. You see that it's supposed to be what? 50% as against 10% that you have there. Now, as per the depreciation is on year-end balance of no current asset. And I've told you, in at the end of the current year, our year-end balance is 1266, and the addition was 66, and we are increasing that addition by 20%. So if an item increased by 20%, it will increase to what? To 120%. So 120% of 66 is what gave us this 79. 79 plus 1268 will give us 1345. This becomes the opening balance here. So the addition here will increase by 20%. That is to 120%. 120% of 79 will give us 95. So do the same thing. We have what? Closing balance here. Closing balance in year 2 becomes opening balance in year 3. 120% of 95 is 114. So these are the closing balances of no current asset gross before deducting depreciation. And the question says that depreciation is charged at what? At 10%. So charge 10% on the closing balance of non-current asset. We have what? We have our depreciation. Okay. Free cash flow year 1 to 3. Free cash flow year 1 to 3. Mrs. Modupe, hope it's not that I did not make the Sunday I asked you to do yesterday. 93 plus 15 plus 135 plus 135 minus 20 minus 79. It is 93 plus 15 plus 135, okay, minus 20 minus 79, 144. Okay, I'm coming. Let me check this one again. 144 plus 28 plus 144 again minus 21 minus 95. 200. What happened? 199 plus 43 plus 155 minus 24 minus 114. 259. That should be mixed up somewhere. Okay, I understand now. 93, 1 minute please. Let me confirm what you just said. 93 minus 15 plus 135 minus 20 minus 79. Mrs. Modupe, so this way, look at it, look at this tax. Okay, let me highlight it so that you see what I'm talking about. This is tax, so it's an outflow. This is incremental working capital. It is also an outflow. Okay, so they should be within brackets. So they should be within brackets. So the figure is correct. Okay, the figure is correct. Just put the tax in bracket and the working capital in bracket. You get that figure there. So let's go to the next question, which is question number 4. Now, what are we asked to do here? Let's go and see the requirements. Required, calculate, showing all relevant workings, the economic value added ever for the year ended December 31, 2015. Make use of the adjusted opening capital employed. Comment on your result and make appropriate recommendations. B, irrespective of your answer in A above, assume the company's current ever is 120 million and that this will decline annually by 2%. Take note of this language here. This will what? This will decline. It's not grow now. This will decline. This will decline annually by 2% for the next 10 years and then increase by 4%. Okay, this is the second one here, and then increase by 4% into perpetuity. Assume the following for this part only: cost of equity 14%, WACC 10%. Calculate the market value added, MVA, by the company. Show all workings. So in this question, I want to calculate economic value added. I also want to calculate market value added. Requirement A is economic value added. Requirement B is market value added. And I've told you that when you discount your economic value added, you get what? Market value added, right? When you discount your economic value added, you get market value added. So the first thing here is to compute our economic value added. So let's go and read the question and we'll see the information we have to pick. I have told you, ever should be a very simple question to solve in the exam. If it comes out of the exam, it cannot take you more than 20 minutes to finish question on ever because the adjustment are just 5 to 6. You understand? So take opportunity of the question we want to solve here to learn the necessary adjustment with respect to ever. Now let's take the question together. Jack Limited is a family-owned business which has grown strongly in the last 50 years. The key objective of the company is to maximize the family's wealth through their shareholdings. Recently, the directors introduced value-based management using economic value added ever as the index for measuring performance. You are provided with the following financial information: statement of profit or loss and other comprehensive income for the year ended December 31, 2015. Now look at our income statement. We have our profit, operating profit. Operating profit is what? Is written as profit before interest and tax, right? So operating profit of 340 million. We have our finance charges of what? 115 million. We have our profit before tax, 225 million. Tax at 25%, which is 56.3 million. Then we have our profit after tax. Now we have this relevant note here. Note 1. We have 2015, we have 2014. 1. Capital employed from the statement of financial position. In 2015, the capital employed was what? 6285, while in 2014, it was 6185. Now, operating cost, that is note 2. Operating cost, this is what the question is giving you here. Okay, it's not shown on the face of this statement. Now, the operating cost will have been deducted from your gross profit to arrive at what? Operating profit, right? So the item deducted to arrive at that operating profit is the breakdown that the note is giving you here. Okay, that's what the note is giving you here. Now, we have depreciation. Depreciation for 2015 was 295, 285 in 2014. Provision for doubtful debt, 10 in 2015, 2.5 in 2014. Research and development, 60 in 2015, nothing in 2014. Other non-cash expenses, 35 in 2015, 30 in 2014. Marketing expenses, 50 in 2015, 45 in 2014. That is note 2. Now, 3, economic depreciation is assessed. Can you see? Economic depreciation is assessed to be what? 415 in year 2015. Remember that one of the adjustments I explained on this platform is what? Is the treatment of accounting depreciation and economic depreciation. I made mention of the fact that because accounting profit can be manipulated through what? Accounting depreciation. If managers want to increase profit, then they should find a way of reducing what? Depreciation, isn't it? So if depreciation is reduced, profit will what? Will be maximized. Now, because of this, EVA does not recognize accounting depreciation. Okay? EVA does not recognize accounting depreciation. Where you have accounting depreciation, it has to be added back to profit. We have explained this in detail in our introduction to the what? To the topic. Now, in place of accounting depreciation, then you charge your what? Economic depreciation. And you can see the information here. Economic depreciation is assessed to be what? 415 million in 2015. Okay? Economic depreciation include any appropriate amortization adjustment. Okay, you might not understand that statement now. When you want to solve, I will expatiate on that statement. Okay, I will expatiate. In previous year, it can be assumed that economic and accounting depreciation were the same. So in 2015, in 2014, both economic depreciation and accounting depreciation are the same. Therefore, no adjustment is required as far as 2014 capital employed is concerned. Okay? Note 4, tax is a cash paid in the current year. Now, what did I say concerning tax? I said if you want to do your tax computation, if you are given tax in the additional information, ignore the tax in the income statement. Can you remember? I think I mentioned that if you look at the additional information and you see tax in the additional information, ignore the tax given in the face of the income statement and go with the one in the additional information. So this question says tax is the cash paid in the current year, which is what? 45 million. And an adjustment of 2.5 million for deferred tax provisions. There was no deferred tax balance prior to 2015. So what does this mean? Before 2015, there was no deferred tax. But in 2015, we are now having deferred tax of 2.5. Is that an increase or a decrease? Obviously, that is an increase in deferred tax. And I've told you when you are doing your tax computation, increase in deferred tax is what? Is added, while what? Decrease in deferred tax is what? Is deducted. So since this is an increase, when we are computing our tax, it's going to be added to our tax. Let us continue. The provision for doubtful debt was 22.5 million on the 2015 statement of financial position. Okay, so when we get there, we use that as well. 6, research and development cost is not capitalized in the account. Look at it. Research and development cost is not capitalized in the account. And what is the principle of EVA? EVA is saying that whether your R&D expenditure meets the requirement for capitalization as set out in IS 38 or not, you must capitalize. EVA does not permit you to expense any form of research and development expenditure. Okay, so whether it meets the criteria for capitalization or not, you must capitalize. And if you capitalize, you have to compute appropriate amortization on the capitalized expenditure and deduct it from both profit and capital employed. Okay, So let us continue. It relates to what? A new project that will be developed over 5 years and is expected to be of long-term benefit to the company. The first year of this project is what? The first year of the project is 2015. So that implies that you have to capitalize your R&D in 2015. The first year of capitalization is year 2015, okay? It's year 2015. Let us continue. The company has been spending heavily on marketing each year to build its brand long term. I think we have a marketing expenditure in the question, right? Yeah, I think we have it right there. It was expense, so we need to add it back as well. Estimated cost of capital of the company is equity 16%, debt pre-tax 5%, and gearing is what? Debt equity ratio 1.5 to 1. So calculate showing all relevant working economic value added. Let's go and solve this question. Let's go and solve this question. Now, what is the formula for EVA? EVA is computed as NOPAT, N-O-P-A-T minus WACC times what? Opening balance of capital employed. Let me take it again in case you've forgotten. The formula I gave you is that EVA is equal to what? NOPAT, N-O-P-A-T, NOPAT. That is net operating profit after tax minus WACC times opening capital what? Opening capital employed. Now look at it. We want to calculate our EVA for which year? We want to calculate EVA for 2015. So 2015, 31st December 2015 is the date we want to calculate our, we want to compute our EVA. Therefore, the capital employed that we need is what? Capital employed as at 1/1/2015. And obviously, capital employed at the beginning of 2015 should be equal to capital employed at the end of what? 2014, right? So the capital employed I'm going to use is the capital employed as at 31st December 2014. But the operating profit I'm using is what? Operating profit for the year ended 31st December 2015. You can see the connection. You need the profit for the year, but capital employed as at what? As at the beginning of the year, which is end of what? The previous year. Do you understand this concept? Who did not understand? Because these are the key to what? Solving question on EVA successfully. You must be able to know which figure are you what? Are you considering for your computation? You are not just going because I've said add back capital employed. Add back research and development. You are not adding it back anyhow. No, you have to know the period to which you are adding back the what? The research and development expenditure. You don't understand. Now, let me repeat it again. Listen, please. Listen, please. Look at it. Statement of profit or loss as at when? As at 31st December 2015. Now, let me now ask you this question. The capital you use to generate this operating profit here, look at the operating profit. This operating profit of 340 million. The capital, definitely, you have to use capital to generate that money, to generate that profit. The capital you put in that business to get your 340 million, when would you have put it in the business? Is it at the end of 2015? I want that response from you. That person that said that he did not understand. The capital that we use to generate this 340 million, was it the capital we put in the business as at the end of 2015? Beginning. So the beginning is what? The beginning is 1/1/2015, right? So the capital I use to generate that profit is the one I need for the computation of my EVA, not capital at the end of 2015. And obviously, capital at the beginning of 2015 is what? Equal to the capital at the end of 2014. So The profit I need is as at the year ended 31st December 2015, but the capital employed is as at 1st January 2015, which is equal to 31st December 2014. I believe it's clear now. Is it clear now? Please, excuse me 1 minute, please. So let us continue. So the first thing you compute is NOPAT, okay? Let's compute our NOPAT, which is net operating profit after tax. I told you to compute your NOPAT, you are starting with what? Profit before interest and tax. Did I say that? Now, yes. Look at it. Let's look at this question together. Look at this question. This is my profit before interest and tax, right? 340. Now, you see that when I prepared this financial statement, I deducted my finance charge, right? I deducted my finance charge. Because I have deducted my finance charge, it means my what? My tax has reduced, right? Are we there? I deducted my finance charge before computing my tax. Therefore, my tax payable has reduced. But now, look at the profit I'm using. Instead of me to use profit after tax, I'm going back to using what? Profit before interest and tax. It means I have what? I have disregarded that interest. But I have already recognized the fact that that interest is saving me tax. It means when I'm computing my tax, the tax I think I'm saving, I should add it back to the tax. When I get to that point, I'm going to explain comprehensively. Okay? I'm going to explain it comprehensively so that you understand. Now, you will pick your operating profit. When you pick them, you now go back to the additional information. Look at all those adjustments that I gave you. I think 6 of them, right? Look at those adjustments I gave you and start picking them one by one. Now, depreciation. What did I say about depreciation? I said accounting depreciation is disallowed. Abi, look at it. This depreciation was deducted before you got that 340 operating profit. Therefore, that depreciation should be added back to my profit. Now, in place of the depreciation, I will now come and what? Deduct 415. So what is the treatment? Add back 295, deduct 415. Add back 295, deduct 415. Do you understand? Add back accounting depreciation, deduct economic depreciation. That is adjustment number 1. Okay? That is adjustment number 1. Okay, so let us continue. Number 2, provision for bad debts or doubtful debts. Provision. Don't forget, I'm not dealing with 2014 for now because I'm adjusting what 2015 profit. So all the figure that will affect that profit is what I will be looking at. You understand? So it's the figure for 2015 that will affect the profit of 2015. So provision for doubtful debt. Provision for doubtful debt. What did I say about provision? Remember, I took you back to SS1 on that day that I explained this principle. I took you back to SS1, Abi, that I show you the treatment of a provision for bad debt. That when you have an increase in provision, it is treated as what? As an expense, right? But if you have a decrease in provision, it is treated as an income, right? Now, provision is not allowed as far as ever is concerned. Okay? Provision is not what? It's not allowed. Where the accountant has made provision, and I think I told you the reason, because ever believe that you charging the provision is associated with you being prudent. So it can lead to overprudence on the part of the accountant. So anything that will lead to overprudence is what is disallowed. So look at my provision for doubtful debt here. You can see that it's part of my operating cost, right? So because it is stated under operating cost, it means it is an increase in what? It is an increase in provision. So it will have been deducted from my profit. So what do I do? I will add it back to that profit. Okay? Now, next one is what? Research and development. Research and development must be capitalized, whether or not it meets the criteria set out in IAS 38. So therefore, that 60 million that was previously expensed must be what? Must be added back. Okay? You know, you subtracted 60 before. So for you to cancel that, what do? You just add back the 60 so that you cancel the treatment from there. That is that. Now, other non-cash expenses, 35. Part of the adjustment we discussed, Abi, it is a non-cash expense, so you have deducted it. What do? Add it back. The marketing expenses, I also explained the same thing. You can see that all the adjustments are already here. Can you see it? That's why I say ever is what? Is the cheapest question you can solve in your exam and get the cheapest mark. And if ever is to come out, I can bet you it's going to be a 20-mark question. If ever is going to come out, then it has to be a 20-mark question. So take note. And the fact is that it's been long that ever was set as a question. So it might be your turn to go and face ever. So we've done that. We now, okay. Now, go and look at what this information tells us. Information 2. You know, I said that if you capitalize all these expenses, if you capitalize them, what did I say you need to do? You need to go and compute appropriate amortization, right? You have to compute amortization on them. And when you compute amortization on them, the amortization should be used to what? To reduce your profit. And it should also be used to reduce your what? Capital employed for that year, right? But the question as what? As stated otherwise here, look at it. Economic, when economic depreciation, look at it. Economic depreciation include any appropriate amortization adjustment. So I don't need to compute any amortization again. That is the reason why the question did not even give you the basis to compute amortization. However, it gave you the basis for research and development, but no basis was given for other marketing expenses and I think advertising, Abi, or whatever. Do you understand? So come and see here. IDP, the question did not tell me that economic depreciation include appropriate amortization. This is what I would have done. The question says research and development cost is not capitalized in the account. It relates to a new project that will be developed over 5 years. Can you see that? Over 5 years. And it is expected to be of long-term benefit to the company. The first year of the project is 2015. Now, because the question has already told me that this research and development cost what will be for 5 years, I will have just divided that 60 by 5 and get my 12. I will not deduct it from profit. But because of that statement in note 2, that economic depreciation include any appropriate amortization adjustment, then I won't go and deduct any amortization again. I don't know whether you are with me on this platform today. Are you sure you are here? Are you here? Or we're already sleeping? You know, I like to sleep. If you are sleeping, let me just join you so that we sleep together. So that when we wake up, we continue. Okay, that's just by the way. So you can see the treatment we give to research and development. We are adding it back to profit, right? Because it has to be capitalized. We cannot expense it. It has to be capitalized. So let us continue. Now, I now left with my task. Don't worry. After this, I will go to the solution and see what I'm talking about. After the adjustment here, then we are left with our what? Our tax. I mean, we are left with tax. Now, ordinarily, this is the tax I would have started with. Profit after tax. This is the one I would have started with. But the reason why I cannot start with that is because of the additional information provided here. Where do we have that information? This information here, excuse me, no. Okay, tax is the cash paid in the current year, which is of 45 million. So the moment you see tax in the additional information, please go by the one in the additional information. You know that I'm stressing it, Nabi. Bukola, that is the reason why before I started, I told you the capital employed we are going to use, and I told you the profit we are going to use. Are we using capital employed for 2015? Obviously, no. So if you go and add that capital research and development to capital employed, you are making a mistake, because the adjustment of capital employed should be made in 2014, not 2015 figure. The research and development, the first year is what? 2015. The question has told you that the first year of the research and development is what? Is 2015. So if I want to capitalize it, when will I capitalize it? I will capitalize it in 2015. So if you now go and add it to 2014 capital employed, consider that I'm making a mistake. You need capital employed of 2014, not of 2015. Research and development is for 2015, so it affects not the capital employed for 2014. Then you add it back now. If it asks now, if 2014 has R&D, you add it back. I've already given all the details I already given to you. What to add back? I've given you the whole note about the adjustment. So let us continue. Now, I will pick my tax here, 45 million. Okay, I will say tax 45 million. When I pay that 45 million tax, then next is what? Now, the question now says an adjustment for what? 25 million, sorry, 2.5 million on for deferred tax provision. There was no deferred tax balance during prior to what? 2015. So what will I do? Increase in deferred tax should be what? Should be added, right? So increase in deferred tax, because prior to 2015, there was no deferred tax in the book. But now in 2015, we are having deferred tax of what? 2.5. So it means deferred tax has increased from 0 to 2.5. Okay? Deferred tax has increased from 0 to 2.5. So what will I do? I will add that 2.5 to 45 million. Now, let us continue. The next one adjustment I need to make is what? Is this finance charge now? Don't forget, on this 115 million, I did not pay tax. I did not pay tax now because I deducted it before computing my tax. But now that I'm starting my computation with what? With profit, with operating profit, it means I must go and pay tax on that interest, because the interest was deducted before I computed my tax. So my tax should have been, my total profit should have, upon which I will charge tax, should have been 340 plus 115. Okay, it's supposed to be 455. But I only pay tax on what? I only pay tax on what do you call it? Sorry, so it's supposed to be 340, but I deducted interest, I paid tax only on 255. So it means I have to go back, that finance cost, I will have to compute additional tax on it because I'm going to pay tax on it because the profit I'm now using is what? Is operating profit. Operating profit is including what? Is including finance charge. So I have to pay tax on it. So the tax on it will be 0.25 times 115. That is 28.75. So you can see that I'm going to have 45 plus what? Plus was it 2.5 plus 28.75 as my what? As my tax. That is the tax we go and deduct from the profit of 2015. And when you make this adjustment, you get your net operating profit after tax. You can see that all the adjustments we made there are not more than 6. So let's go and see what I've been saying here. Let's see. So you see, we have our operating profit. Can you see that? Operating profit is this. No cash items, 35. Accounting depreciation, 295. Doubtful debt, 10. Research and development, 60. Marketing expenses, 50. Less what? Economic depreciation. Okay? Economic depreciation is what? Is sorry, this line is not supposed to be here. That line here is not supposed to be here. After that 50, we are not supposed to have line there. Do you understand? So our economic depreciation is 415. So how did I get this tax? How did I get this tax? Let's go and see how we got that tax now. The one I just explained. So see my tax. 45, 2.5, and 28.75. That gives us what? The 70 what? 71.25 that you have here. Okay? That gives us our 71.25 that we have here. So when you add this and this, these are the total that you need to deduct from your what? From the sum of your profit and marketing expenses, and all other items that we added there. Deduct 486.25 from it. So our no part is what? 303.75. Let me come again. Bisola, please mute your video, please. Mute your video. Yeah, thank you. I didn't get you, Ikagu. Increase in factor is to be deducted. Yes, that's what I said now. What did I say? I said increase in the VAT tax, deduct. Decrease in the VAT tax, do what? Add back. Okay? So your statement is correct now. Your system is correct. Let's continue. So this is how we got our what? Our net operating profit after tax. Let me take question on this no part before we go to capital employed. Atinuke, I didn't get you. What did I say before? Increase in the VAT tax, deduct. Decrease in the VAT tax, add. So how did I put it? Did I say increase in the VAT tax, add? Oh, sorry, that was a slip of tongue, please. It was a slip of tongue. When you are see, let me tell you the logic so that you understand. So that you not cram it. Now, if you have your deferred tax, it's a future tax obligation, Abi. It's a future tax obligation. So, because it's a future tax obligation, if it increase, then it means what you are paying in the future has increased, Abi. So it's not part of what you are paying in the current year. Do you understand? It was not part of what It will not be part of what you are paying currently because it is going to be deferred to a future date. Did you understand? So that is what? Increase in deferred tax. It's a deferred tax. So it should be removed from what you are paying in the current year because it's a future tax what? Obligation. Do you understand? So you don't have to cram it. Okay? You don't have to cram it. Since it's a future tax obligation, it will not form part of your current tax obligation. I believe that is clear, Abi? So that you don't forget. Don't cram it. Don't cram it. If it is increased, it means your future tax obligation has increased. So you are deferring that payment to the future. So it will be deducted. But if it is what? If it is a reduction, then it means your present tax obligation is what? Is increasing. Then you add it to present tax obligation. I believe that is clear, Abi? Are we clear now? All right, thank you. Let's continue. So that is the computation of our no parts. That's the computation of our no parts. Now let's not go to capital. Do you have question on the no parts? Do you have question on the no parts? So that we can continue. No. Now, the next one we need to conclude is what? Compute is what? Is capital employed. Capital employed. And I've told you that the capital employed is what? The capital employed should be capital employed as at the end of 2014, Abi, which is the beginning of 20 what? The beginning of 2015. Okay? The beginning of 2015. My host, please can you confirm that you can hear me clearly? Hello, can you hear me?
Yes, sir.
Okay, all right, thank you. So, now our capital employed for 2014 is what? Our capital employed for 2014 is what? 6185. Can you see that? Because we need capital employed at the beginning of the year. Capital employed at the end of 2014 is going to be capital employed at the beginning of what? 2015. So we have 6185. You now go and look at what are those figures that can affect 2014 capital employed. So number one is, come and look at your, you will see that in 2014, there was no research and development, Abi. But we have what? We have depreciation, right? Can you see depreciation there under 2014? You will see that the depreciation I deducted from 2015 profit is different from the depreciation, the depreciation I added to 2015 profit is different from the depreciation I'm adding to capital employed for 2014. Can you see that? So add your depreciation back to 2014, capital employed. Now, for provision for doubtful debts, this is not the amount you are going to add back. Take note. Let me explain. You are not going to add back 2.5. Why? Because 2.5 is what? It's an expense, Abi. You can see. It's the breakdown of the operating expenses. So 2.5 is an expense. So because 2.5 is an expense, it means that is an increase in what? That is an increase in provision. Okay? That is what? An increase in provision. Are we there? That's an increase in provision. So because that is an increase in provision, I need to go and get what is the total provision at the end of 2014. You know, it is the total provision that you are going to deduct from your what? Your debtors balance in the statement of financial position. Why the increase goes to profit or loss, right? So I have gotten the one that goes to profit or loss is what? 2.5. Abi, is 2.5. But the one that will go to capital employed, okay, the one that will go to statement of financial position, how will I get it? Now, let's go to, where do we have that note? Okay, look at it. The provision, look at note 5. Look at note 5. The provision for doubtful debt was 22.5 million on the 2015 statement of financial position. Now, look at it all. In 2015, statement of financial position, SOFP, my provision for doubtful debt was what? 22.5, right? Hello, are you there? But if you look at that same year, 2015, if you look at that same year, 2015, what was the increase in deferred tax? Increase in deferred tax was 10. So remove that 10 from 22.5. You have what? We have 12.5. It means that at the beginning of 2015, provision for doubtful debt was what? 12.5. Now, it now increased by what? By 10 in 2015. And that is what brought the figure to what? 22.5. So, what's the implication of that? The implication is that as at the end of 2014, provision for doubtful debt was 12.5. If it was 12.5 at the beginning of 2015, then obviously it was the same 12.5 at the end of 2014, right? So the provision for doubtful debt that I'm going to add back to my capital employed for 2014 is 12.5, not 2.5. Okay? Let me repeat it again. Look at the additional information given to us. We are told that, let's go to the information again so that I'll see what I'm talking about. The provision for doubtful debt was what? 22.5 million on the 2015 statement of financial position. 2015 statement of financial position will be as at when? As at 31st December 2015. Provision for bad debt was what? Was 22.5. That is the total provision on that date, right? But in the income statement, what is the amount of provision we have there? We have 10 million as provision. So it means that in 2015, our provision has increased by what? By 10. Look at it. Increase in 2015 is 10. And the total at the end of 2015 is 22.5. So what should be the total at the beginning of 2015? Let me give you that assignment now. Take your pen and your jotter, okay? $12.5, good. 12.5. So at the beginning, your provision is what? Is 12.5. Abi, is 12.5. Since depreciation is 12.5 at the beginning of 2015, it means provision is 12.5 at the end of 2014. Do you understand now? That's the reason why we are adding 12.5 back to what? Back to this figure. So I will pick this one, okay? I will add back 285. I will add back what? I will also add back, what do you call it? I will also add back 12.5, not 2.5. I will add back 12.5. Now, other non-cash item 30, I will add it back. Marketing expenses 45. I will also add it back. Okay. Please let me see. In previous year, it can be assumed that economic and accounting depreciation were the same. Okay. You are not even adding your depreciation. Okay. Because normally, if I add back my depreciation, I should also go and deduct what? Economic depreciation, Abi. But the question has told me that in previous year, what's my previous year? 2014. In previous year, accounting depreciation and economic depreciation were the same. Therefore, I don't need to add back accounting depreciation again. Did you understand? Normally, you see that I first added this, but when I now check the additional information, if you add it, before you can add it, there must be what? Economic depreciation that you are going to use to replace it. So, because the question did not give us economic depreciation for 2014, that is why the question gave this information that in previous year, it can be assumed that economic and accounting depreciation were the same. Do you understand? So these are the items we are adding. Repeat this, add 12.5, add 30, add 45. You get your adjusted capital employed. That's that. Ever is straightforward though, I'm telling you. Ever is straightforward. These are just the adjustment. And the adjustment, that is the one good thing about ever is that the adjustment will always go the same way. So the next thing we need to go and compute is what? Our cost of capital, which is our what? Our work. We are given our cost of equity to be 16%. Our what do you call it? Gearing was given as what? 1.5:2, right? 1.5:2, meaning that debt is what? 1.5. Equity is what? Equity is 2. Equity is 2. So 16 times 2 over 5. The total will be 5 now. I mean, the total will be, is it 5? It should be 3. What did I use? Excuse me. Let me check that computation well. Let me go and see. These 2, and the other one is what? Let me go and check the gearing ratio, please. Let me confirm it so that I'll be sure of what we are doing. $1.5 to 1. Oh, okay. Okay. I understand now. Now, look at the ratio given to us. It's 1.5 to 1, not to 2. 1.5 to 1, Abi, meaning that debt is 1.5, equity is 1. Because it is a ratio, okay, I can convert that decimal to what? Whole number by multiplying it by what? 2. If I multiply debt by 2, I will also multiply equity by 2 so that the ratio will still be maintained. So 1.5 times 2 is 3. Okay? And 1 times 2 is also what? It's also 2. So 1.5:1 is the same thing as what? 3:2. Okay? 1.5:1 is the same as 3:2. If you like, you can still maintain this, but I only converted it to what? To whole number. To whole number. So that's what happened here. You can see that's what happened. Equity is 2. 2 times 16 over 5. Debt is before tax. So 5, that is their cost of debt. 1 minus the tax rate of 0.25 times 3 all over 5. So when you do this, we have 8.65. We have 8.65%. That is our weighted average cost of capital. That is our weighted average cost of capital. Then you now go back and compute our EVA. Go back and compute our EVA. So, sorry. So pick the 303 here. Can you see that? You pick this 303. Come and pick the adjusted capital employed, which is what? 6272.5. 6272.5. Now, this adjusted capital employed will now be multiplied by what? By the WACC. We have 0.0865 times 6272.5. That is 542.57. Now deduct it from 303.75. We have 238.82 negative. Okay? Look at it here. That's what we have here. This is our ever. Now look at what happened here. In the income statement, what profit do we have there? In the income statement, what profit do we have? Let's go there. The company made a profit of what? 168.7 million. If a company declares profit of 168.7 million in the annual general meeting, what do you think the shareholder will do? The shareholder will be happy, Abi? They'll say, oh, excuse me, that the management have done well because they've been able to generate profit of 168.7 million. But when we assess this management on the basis of ever, you see that they have what? They have only reduced. So the management did not add any value to shareholders. Rather, they are destroying the existing value. Okay? The market value of the company's share is going to reduce by 238.82 million. Okay? Despite the fact that 168.2 million profit was declared. Can you see the importance of ever now? That's the importance of ever. Ever will give you an unbiased what? Unbiased judgment with respect to the performance of management. Whereas profit will give you a biased what? A biased judgment, because profit can be manipulated by lot of what? Lot of management attitude. Because management want to maximize their own return. Perhaps their returns are tied to what? How they are able to increase profit. Because of that, then they will do everything possible to make sure that profit is maximized. But if you go and judge them based on the economic value added, now we see that the company is not adding what? Value. Where are you giving work? You're only giving work in requirement B. And the question say for this part alone, please read details. Read details. Don't go and make all these little mistakes. Look at it. Look at what the question tells you. Look at the requirement. Look at the requirement. Assume for this, the following, assume the following for this part only. Assume the following for this part. Which part? For part B. You have been given the basis to compute your work in what? For requirement A. This is how to compute your work. So if you are applying information for B, you are applying it to A, you are not doing the right thing. Please read the question and avoid all these little mistakes. Yes, it's good too. Yeah. If you do that, you get the same thing, Stephen. You get the same thing. So let us continue. Please, so one thing is for you to know how to solve the question. Another thing is for you to calm yourself down so that you don't make costly mistakes. Your approach might be right, but your figures may be wrong. So there are two different things. On my word, Francis, explanation on my word. explanation of my words. Okay, now let me tell you now. Disregard that 5. Go and use this. If that is what is giving you issue, forget about the 5 now. Forget about the 5. Okay? Don't use the 5 again. Come to where I have that work. Where you have 2, put 1. Where you have 3, put 1.5. Where you have 5, put what? Put 2.5. I believe that is clear. Just divide them by 2. 1 here, 1.5 here, and when you have 5, put what? Put 2.5. I believe that is clear. So the 5 should not create any issue for you. So that is requirement A. Now, look at it now. Comment on your result and make appropriate recommendations. So we are not done yet. The first part is computation. The second part is, even though I have commented, let's look at the comment again and the recommendations you may need to what? You may need to give the examiner. Yeah, don't worry. Now, the company is what? The company is currently destroying value. Yes, I said that earlier. The company is currently destroying value as it is failing to meet the economic cost of its own capital. This is an unsustainable place, unsustainable position in the long term, and will lead to shareholders' dissatisfaction. This is what I'm saying. Okay? This is what I'm saying. What does this question generate as profit? 168 million, abi 168.7 million. Now, come in. Sorry, 1 minute. 1 minute, please. Excuse me. Okay. Now, look at the profit it generated. The company generated 168.2 million profit. But when we compute our net operating profit after tax, okay, we discover that the NOPAT was just 303 million, abi? Good. Now, for this company to generate 303 million, the company used capital now. The total capital used, okay, was what? Was 6272, but not the whole amount was used in that year. The amount that was used in that year is the what? Proportion of the work. That is the opportunity cost of the capital employed. Our capital was gotten as 8.65%, okay, at 8.65%. So if we get our capital at 8.65%, multiply that 8.65% by the total capital of the company, which is 6272.5. Do you understand? So that's what we did here. If you multiply this by this is the amount of capital consumed for that year. Okay? That is the amount of capital consumed for that year. So capital consumed for that year is 6272.5. Let's calculate it. 6272.5 times 0.086 what? 865. We consume 542. Look at it. We consume the capital of 542 only for us to generate a profit of what? A profit of 303 million. Can you see that now? So that is why the company is destroying what? The value of shareholders. Okay, the worth of the shares is being reduced. Can you see that now? 238.82 million is the value by which the existing market value of the company's equity is going to what? Is going to reduce. Did you understand that? So that is what led to this comment here, that the company is currently what? Destroying value as it is failing to meet the economic cost of what? Of its capital. The economic cost of its capital is 542 million, but it generated only profit of 303. So it is not meeting up with what? With capital consumption. So this is an unsustainable position in the long term and will lead to shareholders' dissatisfaction. In the beginning, you can see that profit is rising, but it will get to a time that the company will run into trouble because of cash flow problem. Okay, because of cash flow problems. In the short term, okay, that is why profit is not good. Is what? It's not good for a long-term performance measurement. For you to measure performance long term, then you have to base it on what? On cash flow. Okay, on cash flow. Do you understand? And that suggests the reason why the main objective of the organization is what? Is to maximize shareholders' wealth and not to maximize profit. So if we are maximizing profit, then it means we can be getting profit, we'll be generating profit without adding value to the company. And you know it will have a devastating effect on the company in the long term. So the question can tell you, look at it. Though the question was not directly did not directly state that today here, you can just say make appropriate recommendation. Abi, make appropriate what? Recommendation. What appropriate recommendation are you going to make? To make recommendation, what the question wants you to see is how can the company improve the position? How can the company improve the ever? Okay, how can the company improve the ever? That is the comment the question wants you to make by saying that comment and comment on your what? On your result. So now, if you want to make a recommendation, what are the recommendations we are going to make? Number one is that if there is any asset that is in excess of requirement, what do? You need to sell off the assets, okay, to minimize capital cost. You are carrying an excessive amount of capital, okay, of capital employed. Then you need to what? You need to dispose. You need to dispose such assets so that you can improve your what? Your profitability. You can improve your profitability. Okay. 2, exercise tighter expenditure control to reduce expenses. Okay. Exercise what? Tighter expenditure control. Tighten up your expenditure control procedure. Yes, I do asset, Alabi. I do asset. You have an I do asset that you don't need. So it's better you sell it off so that your cash flow position can be what? Can improve. Did you understand? Now, I said number 2 is what? Tighten up your expenditure control procedure. Make sure that you limit amount of your expenditure. If I thought you are going to what? Spend on an item, it should be reasonable. Okay? It should be what? It should be an item that will add value. You don't just spend anyhow on your what? On the expensive. Exercise tighter expenditure what? Control. Then 3, adopt a more aggressive sales drive to improve revenue. These are the 3 suggestions you are going to give to the examiner. Okay? These are the 3 suggestions you are going to give to the examiner. So, instead that the question says comment, or the question will tell you, suggest how the economic value added can be improved. And these are what you should be ready to give to the examiner. Please, I still don't understand the interpretation of the ever. How to determine if it's good or bad. It will be good if it is positive now. If your ever is positive, it means we are adding value. If your ever is negative, it is not good. Look at it. This is what you make. You are spending what more than what you make. You understand? You make 542 million. So it is not good now. you spent more than what you got in return. Do you understand? So ever will be a good we have a good position if your figure is positive. But if your ever is negative, then it means your the shareholders value will reduce. Do you understand? Now, if you look at requirement B says regardless of your answer in what? Regardless of your answer in A. Abi, why do you think the question says that? The question says that because you are going to have a negative ever here. And if you have a negative ever, you can't have a market value added. Okay? If there is negative ever, there's no way you can have market value added. That's what the question says, irrespective of your calculation in A, assuming the ever is what? Is 120 million. Let's go there so that you see what I'm talking about. Irrespective of your answer in A above, assume the company's current ever is 120 million and that this will decline annually by 2% for the next 10 years. Our current ever now is what? We are not using the one we have in A because the one we have in A is what? Is negative. We cannot use to calculate market value added. So assume the current ever is 120 irrespective of your answers in A, and that it will decline by 2% for the next 10 years and increase by 4% per annum in perpetuity. Assume the following for this part. Cost of equity. I don't need cost of equity. When you are discounting ever, what you need is what? What you need is weighted average cost of capital work. So compute the market value added. Compute the market value added. Now, when you hear decline, please don't get confused. You are still using the formula for what? Growth rate. You know, it will decline by 2% for the next 10 years, Abi. So that is growing annuity. Growing annuity for 10 years at 2%. But here, instead of growth, it will not be what? Decline. Now, let me come and show you how we are going to adjust the formula. Please take note. Look at annuity with growth formula. Can you see it here? This is my annuity with growth, Abi, formula. Now, where you have R minus G in the formula, it will change to R plus G. I will show you the reason why it will change. Where you have 1 plus G, it will change to 1 minus G. So when you are dealing with reduction, that is decrease, wherever you see plus for the growth rate is to change to minus. So look at what I'm going to do now. The first thing I need to do is to compute my ever. What is going to be my ever for the next 10 years? Because that is what I need to discount, Abi. So my ever for the next 10 years is going to be what? Look at it. 120, 1 minus 0.02. What am I supposed to have here? I'm supposed to have 120, 120 into bracket, 1 plus G. Abi? I was supposed to have 1 plus G. That is current ever of 120, growing it by what? By the growth rate. So that is 120 to bracket 1 plus G. But because it is declining, it is reducing, it is dropping. Then instead of growth rate, will now be declining what rate? Declining rate will now be 1 minus 0.02. Do you understand that? That's the reason why I have that there. Then I will now say all over, instead of R minus G, you can see it's now what? R plus G. R is 0.1, G is 0.02. So R plus G, 0.1 plus 0.02. Okay? All over 1 minus, this formula I'm using, all over 1 minus into bracket 1 minus 0.02, instead of 1 plus what? Instead of 1 plus G, it becomes what? 1 minus 0.02 all over 1 plus 0.1. Now you can see that for 1 plus R, did I change the plus to minus? No. We are not going to change this one to minus because it is discount rate. It is not growth rate. Please take note. This is not growth rate. This is discount rate, cost of capital. So it is only when you have growth rate that you are going to change the sign. Okay, it is when you have growth rate that you are changing the sign. Uh, where you have cost of capital, the sign should not change. Okay, the sign should not change. So when you evaluate that, we have 120 into bracket 0.98 all over 0.12 into bracket 1 minus 0.98 all over 1.1 raised to power 10. Can you see that? N is 10 because we are looking at what will be the present value for the next 10 years, right? So we have 117.6 over 0.12 into bracket 1 minus 0.315. So when we evaluate this, we have 671.3. That is the present value for year 1 to 10. Present value from year 1 to what? Year 1 to 10. Now, we now have to compute what? The present value from year 11 to infinity, abi? From year 11 to infinity. Now, from year 11 to infinity, the first thing I need to get is I need to get the year 10 figure, abi? Don't forget, it is from year 10 that we are going to grow it to what? To year 11. So for year 10, it's going to be 120 to bracket 1 minus 0.02 raised to power 10. Don't forget your future value, okay? Future value, compound interest. Don't forget that. So that's the concept we are using here. So 120 into bracket 1 minus 0.02 raised to power 10. That will give me my ever in 10 years time. Okay, that's my ever in 10 years time. Then I will now grow it by the new growth rate for 2011. Sorry, in year 11. That is 1.04. So the whole of the numerator there is the ever in year 11. That's the ever in year 11. Then what about the cost of capital? It's 0.1 minus 0.04. So multiply by discount factor of the base year. Don't forget, we have explained this one before. So we have 101.97 all over 0.06 times 0.386. So when you evaluate this, you have 655.2. So add what you have here, add it to the previous figure you got, which is 671.3. So when you add the two together, we have 1,300 and what? 1,326.5 as the market value added. So that is that about market value added and the economic value added. I will urge you to go and practice, okay? Practice it, understand the concept, just those adjustments. That's just it. Know how to derive your opening capital employed, know how to derive your what? Net operating profit after tax. So we are supposed to start merger and acquisition today. But what I'm going to do is we're going to do it on Friday, and I will plead with FCA to give me some time on Sunday, whether in the afternoon or wherever, and that will be communicated anyway. I will beg the management to give me some time so that we can cover our merger and acquisition. Okay? So I can cover our merger and acquisition. So let me take your question in the next few minutes before we call it a day. Okay? Question before you call it a day. No question? That is good. There's no question then. It means the class is fantastic. Yes, it's work. It's work. The work given to us in the question in part B, which is 10%, is the work that is the rate. Because look at it. You don't have to cram your rate. Go and look at the profit we use. Is what? The profit we use is for both equity and debt holders because it's profit before interest and tax. Therefore, the appropriate cost of capital is work. Do you understand? Except you want me to forget about except you want me to forget about merger and acquisition. Because if not, we won't have time to treat it. I think some material, okay, don't worry. I'll speak with the management to get you the video for last diet edging so that you can download and watch. You can't afford not to know merger and acquisition. As from experience, when you take edging, we can use 4-5 classes for edging. At the end of the day, student will not treat edging. Okay, they will not treat the edging. Do you understand? So it's better we do merger and acquisition, which is almost certain that will come out. This one also is certain anyway, but it's not all students that do it. But we are going to forward the video to you on the platform, download it and listen to it so that you can get yourself prepared in case you want to solve question on edging. Yeah, that's what I'm saying, Alabi. They always run away from edging. Even though we treat it from A to Z, they will still run away from it. You understand? So it's better we do the one you will not run away from. And if there is time, we now do edging. But if there is no time, then you download the word, download the video and watch if you want to solve edging. So that's the approach we are going to do. Thank you, thank you, thank you. And God bless you. Do have a blissful night rest. Bye. My host. Hello, sir. Maybe my host is watching Champions League. Okay, my host, you are done for the class. Thank you so much.
All right, thank you. Take care.
Okay, sir. Welcome, sir.